all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to The Long-Term Investor, proud member of the Retirement Podcast Network. This week, I had the pleasure of sitting down with Rubin Miller, a chess master, experienced investor, and author behind one of my favorite blogs, Fortunes and Frictions. Rubin's unique background provides a fascinating lens through which he views the world of investing, combining the strategic thinking required in chess with the complexities and uncertainties inherent in financial markets. Rubin and I discuss a wide range of topics in this episode, but they all seem to center around the idea of navigating the unpredictable waters of investing. As always, this episode is packed with practical advice and thoughtful reflections, all of which you can read about in detail in the show notes at thelongterminvestor.com. And now, here is my conversation with Rubin Miller. Rubin Miller, welcome to The Long-Term Investor.
Peter, thank you.
Now, you know this. I always tell people that your blog, Fortunes and Frictions, might be my favorite investing blog out there. And I think part of the reason that you are such a great writer is that you have such a great background of very heady, intelligent, thoughtful things. I mean, you were an options trader. You were a chess master. I love when you wrote about chess. You said chess is complex, but it's not random. And I think it'd be really easy for somebody with a marketing background and zero investment knowledge to look at you and spin up this idea that like being really good at chess makes you really good as an investor. I'd love to start there. First of all, tell people about your experience becoming a chess master at a young age, but then sort of some differences between a game like chess and a, quote, game like investing.
Sure. Thank you. My second time joining on you was a pleasure. Last time with Phil. I'm glad to be here alone this time. I always kind of a unique childhood. I was introduced to chess at a pretty young age, probably like 6 or 7. And I lived in Rochester, New York at the time that had this really robust chess scene. And there was this very sort of well-regarded chess club. And my parents could just drop me off there. It's like free daycare after school or whatever, free babysitting. And there was something to do probably 5 or 6 nights a week. And then also on the weekends. So I was mostly like interested in a game. I'm not like IQ off the charts or anything like that, but I was really interested in the game. I played a lot. And when you play a lot of a game against good players, you get a really good feedback loop, right? So like when you do something wrong against good players, you get punished for it. It's really easy to get better at chess relative to other games by just playing a lot, because even just games against good players become lessons. If you play games that have randomness and uncertainty, like if you sat down and played poker for a while and you weren't really trying to learn, but you were trying to glean things from outcomes, you wouldn't become a very good poker player, because a lot of times you're going to have good outcomes even though you did the wrong thing. You'll have bad outcomes even though you did the right thing. In chess, that doesn't happen because all the information's right there. So this childhood I had of playing so much sort of allowed me to elevate to some levels in the chess world that I probably wouldn't have been able to do on raw talent alone. I'm just not as smart as a lot of my other peers that I was sort of competitive with at the top tier. I do like writing and talking about chess a lot because it's kind of a perfect laboratory to talk about luck versus skill, which, Peter, as you know, in our job is one of the hardest conversations to have with investors and many of our clients or prospective clients, because it's so rare that someone has the humility to accept that how random many of their outcomes are. And if you think about the people that might talk to our firms, like I work with a lot of people in Silicon Valley, and they have worked at companies like Meta or Google or Amazon or Apple or something like that. And they've worked there for 15 years and they have stock and they never sold it and it's grown a zillion% and blah, blah, blah. And they've had this really amazing outcome. And they come to me and they say, like, what should I do with my money? And I'm like, well, don't do stuff like that. Well, you're way better off having not talked to me 15 years ago, because I would have told you the same thing, and the same thing about my philosophy, which is that you can make those decisions. You can hold on to single stocks, and there is a small probability that you'll do really well. And for many people, that is true, and that has happened. But looking back, you have to basically say, was that knowable ahead of time? And I would argue it wasn't. And there's a lot of people who had bad outcomes by owning single stocks or having concentrated positions. And we just don't hear about that as often. Chess is just very different from that because in chess, there's no randomness. All of the information is there on the board. You don't necessarily become a great player for knowing that. You can still make mistakes, right? But there is no randomness. So the blog post you're referring to, which was titled, I believe, "Do Chess Players Make Good Investors?" I would love to tell you that, yes, they do, because I'm a pretty good chess player. Hire me. I'll make great investment decisions for you. In reality, it's not true. Having a mind that can be tactical and strategic is not enough to go and outguess the stock market. And so while I think, and I mentioned this in the blog, I think that being good at things like chess can help you be a strategic thinker when it comes to financial planning and being strategic about the risks and rewards you might be choosing or not choosing in your life. Being a good chess player is not going to help you pick stocks any better.
Well, let me test this analogy with you because you'd mentioned knowable outcomes. And so if I think about chess, for example, there are some known knowns. We know what the different pieces do. There are some known unknowns, which are we don't really know what our opponent is going to do with those pieces. Although if you're really good at chess, maybe you can see certain developments happening. But then there are unknown unknowns. And in chess, if I were going to compare it to investing, it'd be something like half of the board is torn off, or suddenly someone comes by and just adds a bunch of pieces to your opponent or to you or takes it. I mean, that's sort of where the fixed outcome versus randomness of the investment world works. Do you think that's a fair comparison?
Absolutely, because there really are no unknown unknowns in chess. This thread of known knowns, known unknowns, unknown unknowns, for those less familiar, that's how Donald Rumsfeld, that's what he used to describe weapons of mass destruction back in the early 2000s or mid 2000s when we were looking for them. And he was basically saying, we don't have all the information. There's known knowns, there's known unknowns, and then there's unknown unknowns. Making decisions when unknown unknowns are present or potentially present, is probably a better way to say it, is extremely challenging. You have to do the best you can with the information you have. And I think that human brains are just not wired so great for that. Again, that's why chess is such a great laboratory. As you described, an unknown unknown in chess, it's not going to happen on the board. It's going to be someone doing something weird, something illegal. It's a really fascinating thing. I mean, if you look at world champions in various games, if you look at the world champion in Scrabble, there's a little bit of randomness in how you select tiles when it's your turn to pick new tiles. You might get really good ones, you might get really bad ones. But we all know if you go play Scrabble against someone who's really, really good, it's not enough to pick a few good tiles. They're going to smoke you. The world champion in Scrabble is not the same every year, but if you look at the last 10 or 20 years, you'll see the same name a few times. So they can compensate for some of that randomness if you're really, really good. Same thing with poker. It's a little bit more random. It's a little harder. There's a lot of good players. You look at chess, we have years, there was a period in the 1800s where the same person was world chess champion for almost 30 years in a row. The last 15 years have been dominated by one person, Magnus Carlsen. So once you're the best chess player in the world, you're just the best chess player in the world. And it's going to take a lot potentially to dethrone you. If you all of a sudden win the poker championship one year, you don't have a right to say you are definitely the best poker player in the world. There's an element of randomness that happened to work in your favor that got you there. Same thing with Scrabble. You don't have a right to say that it's a truth. It's a possibility and a not unlikely possibility that you're the best Scrabble or poker player in the world. Certainly you have a claim to it. You won the tournament, but it's a tournament that has randomness. If you win the chess championship, you are the best player in the world. There was no randomness. I think that's a big difference. Again, something that we don't think so much about. Our brains aren't necessarily wired to think that way, that someone might win the poker championship and someone still might be able to say, that doesn't mean you're the best player in the world. That's hard for us to think about, but that is true.
Yeah, and this idea of there's skill and luck in any activity is probably one of the most important ideas that I had learned about earlier in my career. And I think it's Michael Mauboussin who talks about how something is pure skill if you can lose on purpose. And so if you think about chess, it would be easy to lose on purpose because there are these fixed rules. In poker, you can't necessarily lose on purpose. In investing, you definitely can't lose on purpose. I actually had a conversation a couple of weeks ago with somebody who's like, well, of course I could lose on purpose with stocks. I just picked the worst ones. And I'm like, well, that's what shorting is. And short selling is even more difficult, arguably, than just buying and holding a stock. So I think recognizing with investing that there is some mix of skill and luck is really important. But I also think that you sort of mentioned this yourself, where your investors, they're just really focused on the known knowns and the known unknowns at any given point in time. But our brains aren't really wired to think about the unknown unknowns. Our brains weren't wired to think about, hey, here comes COVID, even though people were looking at all these different risks. Then COVID hits, that's just something you can't predict. Or you can't predict that somebody is going to fly airplanes into buildings. You can't predict some of these things that just ultimately, if you were trying to protect against them, there really wouldn't be any way to do so without giving up all return.
Part of the reason why we as investors get the long-term returns that are available to us, why there is a long-term return available there, is because we have to accept unknown risks, that planes might hit buildings, that viruses might become pandemics, things like that. I mean, that is part of why we get a return, because we're willing to buy stocks despite that those might happen. But I agree with you entirely, and I think it is something that gets vastly overlooked in a world of sort of quick hit media bites and dopamine hits, is people love comparing things or thinking about things or discussing things that really aren't big needle movers. They're not going to have impactful outcomes in your life. So, for instance, people will compare two very similar index funds. I see this all the time on the internet. Like, do you like this Vanguard index fund that owns US large cap stocks? Or do you like this index fund that owns US large cap stocks that's slightly different? And it's like, I think you should probably be thinking about planes hitting buildings and viruses instead. Like, that is a much bigger driver of your long-term outcomes, is how are you going to act on September 12th, 2001? What are you going to do at the end of March 2020? What are you going to do with your portfolio? Do you have a thought partner, an advisor you work with, or do you have the ability to sort of make decisions on your own? Those things, what you do in those very small windows of time that have these dramatically outsized impacts on our long-term outcomes as people, as family members, as investors. It impacts our money, our happiness, our health. All these things are way bigger topics to explore and inform the way you design a portfolio, rather than some really good index fund is better than some other really good index fund. Sometimes I think that's more fun for people that really love investing, but the truth is it's less impactful.
Well, and I think that in general, I know that you've said something along these lines in your writing before, is that like when you invest in stocks, you know they're going to go up over time. You don't necessarily know that the time horizon that you have for any given goal will match up perfectly along with when stocks are up or they're down. But we know that downturns are going to happen with a similar magnitude and frequency as they have in the past. We just know that. And so we can, like you said, design a portfolio, design a process that allows us to not even really have to make any decisions. So you had a blog post I loved about a 100-plus-year-old Japanese mochi company. If you can somehow pull that anecdote out of the back of your mind to share, I think there maybe is some relation here.
Yeah, that was a while ago. There was this story I read. It was in the Times Journal or something. I think her name was Naomi Isagawa or something like that. She was, 60s or 70s, this mochi, which is like a Japanese tea, I believe. This mochi store in Japan has served tourists for like 1,000 years, just coming to the store to buy the product. And when you have a restaurant and you're trying to make more money, like any business, you think about scale. Okay, people are already here. Can we sell not just the tea, but can we also sell biscuits? Can we also sell cookies? Can we sell bagels? Whatever you're going to sell, they're there. Try to sell more. And what was so cool about her family store, that again had been in her family for centuries and centuries, was they just wanted to do one thing really well, which was make mochi. And that was it. And they thought, if we do that really well, we'll be known for that. We can set expectations with people who might come here. We can deliver on those expectations, and those people will tell other people about this experience they have. If we start to add more products and hopefully increase revenue, that comes with a trade-off of sacrificing what we're really good at. It's almost a distraction, right? It's like in the US or something, it might be like a coffee shop that really just does coffee incredibly well versus Starbucks, which has expanded to all these various product lines. And every quarter they announce their earnings, and stock investors and analysts are all over like, oh, this part of their business was up, this part was down, this is growing, this. What Naomi was trying to do was say, let's just focus on the one thing we're really, really fantastic at and just do that. And anytime there's a downturn, talking heads start forecasting what's going to happen next, what tactical moves you should make in your portfolios. And the reason I wrote that article is because what I firmly believe in is that when you design an investment portfolio with the way you described it, sort of a process, you want a process. And our process is focused on identifying what's a perfect life look like to an investor. They say, I want to be able to send my kids to college and this year, this type of college. I want to retire at this age or maybe this age. My spouse, maybe this age, that age. We want to buy a second home. We want to sell a second home. Whatever it is, I need to identify what a perfect life looks like to you. That's going to then inform the portfolio that we're likely going to have. Once we've identified that portfolio, if you have an investment process that's steeped in humility at the way you manage money, the way my firm manages money, you are no longer going out there trying to outguess all the other market participants and where you think prices are going in stocks. And so for me, if someone comes to me and we build a perfect life, and let's say we've identified that someone needs to own 75% global stocks and 25% bonds. This very basic portfolio, right? That is now my one thing that I need to take Naomi's philosophy about Mochi and implement with 75-25. If we get to 85-15, there's an action item to get back in line. There's no action item because I read the Wall Street Journal this morning and I think something's going to happen. There's no action item because I watched the news and I think something's going to happen. Those aren't reasons to do anything. We have one job: manage risk accordingly based on the life someone's trying to live. And to me, there's only one way to do that, which is identify a sort of long-term investment portfolio that we want to thoughtfully implement. That's going to evolve as their life evolves, but with the information we have now, and then implement it. And I don't really care what else is going on. And I think that's so hard for people to do, to tune out that noise, which is why I wrote the blog post, which is like, look how beautiful the business model of this Mochi story is by avoiding all the distractions. And I think that you and I and people like us that have our philosophy can deliver the same investment experience to people.
Well, I will definitely link to that article in the show notes at thelongterminvestor.com. Incredible that you're able to remember all these things that you've written over the years. And let's focus in a little on what you were talking about, where we're trying to come up with that thoughtful process, build that thoughtful portfolio. You have to kind of choose what your certainties and uncertainties are. So, for example, as of this recording, the 10-year treasury is about 3.8%, the yield. Even if you bought that certain return over the next 10 years, there would be some inflation uncertainty. And so maybe I ought to say we go and buy a 10-year treasury inflation protected security, and that yield is maybe like 1.7, 1.8. So you could guarantee after inflation, your money's growing at 1.7 and 1.8% each and every year. And you've eliminated generally all uncertainties, but you couldn't really grow your wealth at a rate that would allow you to either live your life, do anything other than save, or ever have any sort of chance to retire. So if we know that we need to add some uncertainties to the portfolio, how do you start going through thinking of those different trade-offs, those different expected returns, et cetera?
I remember talking to my mom before I posted this blog post about that topic, about once you buy risk-free investments like treasuries, and then you buy real treasuries, which means you adjust for inflation so that you're not inflation risk, right? And the 1.7% you described, that's if you protect against risk and then protect against inflation. That's what you can guarantee yourself. And it's just not enough to grow someone's wealth. 99.9% plus the people in the world, they're not going to live the life they want to live if they grow at 1.7% guaranteed. So to your point, we have to take risks. But I remember calling my mom and be like, this blog post is going to go wild. I called it the Jimmy Buffett portfolio because you have no worries anymore. You manage risk, you manage inflation, you are toes in the sand, Corona in your hand, Jimmy Buffett lifestyle. And it was like not a very well read blog post of mine. But I thought like the idea of like, oh, people are going to start calling it the Jimmy Buffett portfolio. Just go buy all real treasuries.
Well, maybe this is what's going to allow it to catch on now. We're going to have a second coming here. Sort of like something that doesn't do well in the movie theaters, but crushes once it goes into people's homes.
Now people will know when I submit for conference presentations about the Jimmy Buffett portfolio. Now they'll maybe let me in. So agree with you. Our firm, we think about it this way, which is there's three asset classes we primarily care about: global stocks, normal sort of nominal intermediate term bonds. That's just kind of what somebody thinks was a normal bond. And then ultra short term bonds, which is very similar to cash. The reason why we think about those three is because if we start with the last one, so ultra short term, and we'll use treasuries here for a second. So ultra short term treasury, that'd be like a 3-month treasury bill. It's risk-free and it's going to mature really quickly. So if you say you can get a 6% yield in a short-term treasury and it's a 3-month treasury, I know that 3 months is 1/4 out of the year. So I'll get 1/4 of 6% or I'll get 1.5%. I have a very, very high clarity, basically the utmost clarity of getting 1.5% over the next 3 months. That's super helpful for planning if you can provide certainty, right? When you put in an input into someone's financial plan, or you're just describing how much certainty or uncertainty you're willing to accept, someone being like, I basically guarantee myself 1.5% over the next 3 months, as Peter, you described earlier, maybe there's some inflation risk there, but for the most part, that's a really, really robust input with very little uncertainty around it. That's helpful for planning. Then there's bonds, and bonds, which have the same structure as a short-term treasury that could be very similar as far as like, it's a debt security. You're loaning your money out to someone. You'll get a stated yield, and it'll say you can buy, as you described, a 3.8% yielding 10-year bond. That means your expectation is I'm basically going to get around that for the next 10 years. To your point, you don't quite know what will happen with inflation. It's definitely a little bit more complex than you and I are sort of talking about through here, but that's the idea. Now, in the ultra short-term treasuries, your reality is going to match your expectation. I don't expect any surprises around that. When you buy a 10-year treasury, all of a sudden, you sign up for being a little bit surprised through time. Now, if you can hold on for all 10 years, you should expect to get your yield or something close to it. However, just look back to 2022. 2022, we had this spike in inflation, and intermediate term bonds had a terrible year, I think down about 15% at one point. So you don't expect to say, oh yeah, you'll get about 4% every year, and then have your advisor say, oh, by the way, this year we were down 15%. That's a really harsh outcome or a frustrating outcome for someone that wasn't aware that could happen. And so bonds are different than ultra short-term treasuries. As you said earlier, the longer you hold them, the more reliable your outcomes, but you can have quick shocks to the system based on factors like a shock in inflation or something. So bonds really have to be tied to someone's investment horizon. And then even more so are stocks, because with stocks, you don't get a helpful yield. You can Google a stock yield and it'll tell you the dividend yield is XYZ or something. I know Taylor Schulte was on your show recently, and dividend yields aren't helpful. They don't tell you anything. That's just your investment giving you some of your own money back. It's not like a bond where your return is on top of your investment. So what people should know is that stocks don't give you any helpful information about what to expect, except they have a long-term average. And as you described earlier, Peter, sort of like, that's what's going to inform how we should expect to do. We have about 100 years of data. Stocks tend to do between 8 and 10% per year. Certainly makes sense that, I believe you described a 10-year bond, risk-free bond at around 4%. I know even shorter term bonds right now are about risk-free for 5%. If someone's going to convince me to buy stocks or anything else that has risk, I better expect more than 5%. Otherwise, I'll just go buy what's for free that would yield me more. So for stocks, you'd always expect them to be more than 5%. Turns out the long-term average is about 8 to 10%. That's reasonable. If I'm going to give my money away and buy companies across the globe and own small pieces of them all over and not have any say in how they're run or anything, just sort of a passive owner of them, I could have a really bad outcome, right? We know periods, global financial crisis, the 3 weeks after COVID hit, you can have really bad outcomes as a stock investor. You need to be rewarded for that. You'd expect to be rewarded above any risk-free rate. Turns out it's about 8 to 10% a year, but over a really long time horizon. So your initial question of sort of like certainty to uncertainty, expected returns, I would say you always want to take a snapshot of the risk-free returns. So the ultra short-term one, call it 3 months or 6 months. The 10-year treasury, what you can guarantee yourself, not including inflation, for 10 years. You're always going to buy stocks thinking you're going to get more than that, but that there's some variability around that. And also that you might be wrong. We can have decades where stocks don't do what we wanted them to do. They can't underperform treasuries for longer than 10 years. And so that's why our business is so fascinating, because it's like, hey, we can make all the best decisions, just like at a poker table, and we can do terribly. The longer time horizon you have, the higher probability you will achieve sort of a well-calibrated capital markets expectations, what you thought would happen. But as you know, investors are commonly frustrated. And that's because expectations don't have to match reality. It's why it helps to really understand the things that you own. So that's how we think about certainty to uncertainty. When you design someone's perfect life through their portfolio, you are taking this timeline of things they're trying to accomplish, whether it's college for the kids, weddings, homes, retirement homes, nursing homes, whatever it might be. Those are all inputs. And we have to basically connect the types of assets they own and the uncertainty embedded within those assets, or the expected uncertainty, I should say. And that's how you and I design portfolios.
One of the hardest things I find as an allocator, as an advisor, is just that good decisions can lead to bad outcomes. And something like financial theory tends to work out really, really well over multi-decade horizons. But in the moment, our mental time horizon will shrink to whatever time period we see on the news, in the paper, on a performance statement. And so I think one of the things, even going back to the Mochi, like, what do you do really well? You get this well-crafted plan that is driven by evidence. Empirical evidence has some economic rationale, and you might end up rationalizing feeling good about outcomes if you make a bad decision and it turns out well. But you and I as advisors, if you're diversifying, you're basically always going to have a bad outcome. You're going to own international stocks when they trail the US for over a decade. As you mentioned, sometimes stocks trail cash and bonds for long periods of time. I believe the latest period that was true is from 2000 to 2012. Cash beat the S&P 500. There are two longer periods when you go back to the 50s where that was true, something like a 15-year period and a 17-year period, but those dates are escaping me at the moment. In general, I think, as you noted, when expectations and reality are different, that is how happy you are or not. And a lot of this is trying to convey what is certain, what is not certain, and having a plan in advance.
That's why I love starting with the risk-free rate, because many people at this point are a little suspicious if you say, hey, Peter, I can guarantee you this return. If someone said to my mom, I'd be like, Mom, let me see what they sent you. Let's pause. But the reality is there is a risk-free rate. The issue is that because it was so low for so long, from basically like after the great financial crisis all the way till 2022, we didn't really talk about it. If you took a finance class, you were tested on it, but we didn't talk about it because you weren't going to get anything if you went and bought the risk-free rate. It was like 0.1% or less in the short term, right? And even the 10-year bonds might yield for a while between 1% and 2% per year. Like, who cares? And that was the approach people had, was like, well, who cares? Now that you can go get your about 5% plus in ultra short-term treasuries, well, shoot, now, like we talk to clients about, hey, make sure you don't hold too much cash in your bank account. It's as nuanced as that at this point. Not even just portfolio construction, but like your bank, because banks aren't going to give you 5%. They're going to go get it themselves, right? So I think we just haven't talked about this topic very often, about risk-free rates, until the last couple of years. I think it's a very welcome introduction for people to better calibrate the risks they are taking. As we talked about, you're never going to want to take a risk that you would expect is going to yield you less than the risk-free rate. But I'm blanking on your question now, how we got there. Oh, basically, like, that's where I start. We want to start with the risk-free rate that has no uncertainty, and then we build uncertainty on top of that. And it's always going to be different for different people based on what they're trying to accomplish. But what you don't want to do is, A, be like averse to this idea of risk-free rates, but you also don't want to be sold some crappy, expensive annuity, because that's how annuities are sold. Annuities are selling you certainty. They're not bad inherently, but they can be bad with too high of fees or too low guarantee. So the idea of a risk-free rate should always start on treasuries. You might decide to buy an annuity if you want certainty. That's related to that. You might decide to buy a different type of something that looks like a treasury. Maybe it's not perfectly uncertain, whatever it might be, but that is the sort of foundation that you want to build on when you think about adding risk or uncertainty.
And you talk about annuities. I think that's a great example of people buying something that they look at as more certainty than they get in the stock market or the bond market. And really what they're just doing is trading away their upside to minimize their downside, to shrink the range of potential outcomes. You had a piece recently, not necessarily on that, but on options, which can be used to do that. In general, if I think about how people are using options these days, for the most part, there's a lot of traders out there who are using them as leveraged bets. There's also a growing segment who are using them through these like buffered ETFs that basically say you can have this upside of the stock market and reduce your downside by this amount. And really, to me, when you get into that, a lot of that sort of goes back to what you and I are talking about, where it's if you know what your risk profile is to begin with, and we know that downturns are going to happen with a similar magnitude and frequency as they have in the past, you don't need these certainty tools. Now, we don't live in a spreadsheet. You and I both know this. Some people just sleep better at night with a little. If you can afford the certainty and you can give up some of this, that's fine and well. But in general, I think this is a great example of Wall Street just marketing products that feed off of people's fear.
I love what you said about affording certainty, just because usually people say, I can't afford the uncertainty of the stock market. And what we're talking about these risk-free rates or real risk-free rates is, can you afford the certainty? And so somewhere, most products, like you're describing, these products are being created, they're going to now, the hot thing is to go somewhere in the middle, which is you're describing buffered ETFs, which is basically like, I believe what you're describing, so you would own basically a stock portfolio that then generates some income from selling options. You won't get your full upside of the stock market, but you also want to have the full downside because you're getting some income. We can flesh that out. I know that's kind of a complicated topic. Am I right? That's what you mean by
Yeah, I think so.
Sort of
and
approach?
I don't know that we have to flesh it out more than that, other than identifying that this is something that just says like, hey, I need my range of outcomes narrowed. That let me ask you this. I mean, I feel like you could just change your stock, bond, and cash mix and it would achieve the same outcome. It's simple. It's less interesting. It's something that if you're a do-it-yourself investor, seems almost too easy. And it's something that Wall Street sells against. Wall Street wants you to think that you can do this on your own. And look, none of this is rocket science, but just like if you have a trainer or someone cleaning your house, or if you have a personal chef, they're all going to do a better job than you are. But boy, having a personal chef would be really nice. As that came out of my mouth, my mouth's watering. I'm like, oh, that would be good, actually. I'd probably eat healthier. Anyways, I think in general, people are just, when you seek certainty, you have to know that you are giving up the return that sort of allows you to grow your wealth at a rate greater than inflation without taking undue risk.
I think when you have our job, people come up to you a lot and will say things like, what do you think about this stock or this fund? And I often just kind of turn back and like, what do you think about stocks? My question is like, start with the philosophy. Like, how do you think about owning stocks? Why do you do it? What do you want to accomplish from it? What do you think it means to you? The minute we start with the products, a buffered ETF, someone says like, let's go buy buffer. Like, what are you trying to accomplish? What do you think this does to your range of likely outcomes, right? And I do find that people are often awakened by this idea of starting with a philosophy, because we've lived in this world that gets marketed as just products. No one makes CNBC commercials about having a philosophy. But if buffered ETFs are right for you, I'm not trying to bash them, I don't know. If those are the right product, get there through having a philosophy and then say, oh, that's the right tool for what I'm trying to accomplish. So to talk about sort of options in general, I wrote a piece recently because one of the frustrations I have with the tools that are available to investors is that some of them are actually very helpful, but I almost tell people to avoid them, especially if they're doing things on their own, because you introduce some risks that if you do it wrong, you can really screw things up. And options are a great example, just so people kind of know. So in my 20s, I was a trader. I was a futures trader, which means I traded futures contracts. And futures contracts kind of exist because 100 plus years ago, farmers are living in the Midwest and they say, I have a crop. It's going to be ready at harvest. Let's say it's the fall. Crops are going to be ready in the fall. It's freezing and it's January and my family needs money. Okay, so that's how we came to a futures contract. You go to Chicago, you say, hey, I got some crops that'll be ready in the fall. Might be, I don't know, wheat, corn, pork belly, whatever product it is. You can sell a futures contract and say, hey, pay me now in January, and I will deliver you this product once the harvest comes or once we slaughter comes, whatever it is. That's why futures products exist, is that there was a need for it. The farmers needed it to get money and live. Now there are options, which are basically, you put a date on a futures contract. You basically say, I have the option, I'm going to buy the option to potentially get into that contract, but I also have the option to not do anything about it. So the options are going to be cheaper, or can be cheaper, I should say, but it gives you the right, but not the obligation to do something in the future. So you could buy the option to buy a bunch of pork bellies in October or November at a set price. And so that might be an interesting contract or something. And all of a sudden we have this very robust financial system around futures and options, which are derivatives. So you have the Chicago Board of Trade, you have the options exchange, and it's a whole, robust thing in Chicago. Most of it's online now, some of it's in New York, around the world. But there's a reason that derivatives exist, and they were very helpful. Now, it's not that they're not helpful, but so many people just use them for speculation. You can imagine why it was useful for wheat or corn or pork bellies, not so much for GameStop stock, right? Like now you can trade options on GameStop and you can say, I'm going to buy the right but not the obligation to buy GameStop at $25 a share anytime before next Wednesday. That's the sort of contracts people get into now. And it's like, well, why the heck is that useful for society? I would argue it usually isn't. But I'll give you an example of where it is. And that's what I wrote the blog post about, is options we often talk about as levered bets like you described. And the majority of people probably do use them this way. So if a client came to me and said, Rubin, I love your philosophy, low cost, globally diversified, tax efficient, blah, 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 ... But do you think we could buy some Netflix options? Doesn't fit with our philosophy. Very, very exciting thing to do. You're going to see your money kind of whip around because options are inherently quite volatile. And the way an options contract, say on Netflix stock or GameStop or whatever could work is you would say, okay, Netflix, I don't know what Netflix costs. Let's just pretend Netflix is $400 a share. You would say, I really think Netflix is going to have a resurgence in the next 2 years. So I want to buy the right to buy Netflix at $500 a share in a year from now. Well, that's really interesting because it's like, well, 500 is a lot more than 400. And so someone's probably going to be interested that says, well, I don't think Netflix is going to have a good year. Sure, you can pay me to have the right to buy Netflix stock from me for 500 in a year. It's only at 400 now. I don't think it's going to get to 500. So these exchanges definitely happen. It's a levered bet because it doesn't cost that much to convince someone to make that trade. It's not likely that a stock goes from 400 to 500 in a year. On average, we wouldn't expect that to happen. That's a big jump. But it can. And if Netflix went from 400 to 800 and somebody sold it to you for cheap at 500, you had a really, really good outcome. And that's why in these GameStop and meme stocks, because they're so volatile, the options game is kind of fun for people because you can make a lot of money really quick. You can also lose a lot of money really quick. Long way of getting to why they might be useful is that if you already own a stock, let's say I own Netflix stock, it's at 400 and I really want to get out, but I want to get out at 500. Well, it's not at 500. So there's no way for me to get out at 500. However, I could find that person who thinks it's going to go past 500, who's trying to buy options at 500. And I could say, hey, I'll give you the right but not the obligation to buy Netflix stock from me at $500 for $12 a share or $20 a share, whatever the price would be. I will now collect that price. The outcome I wanted was to sell my Netflix stock at $500. And if it ever gets there, that person is going to make that trade with me. Plus I got the initial money. So that's called a covered call. That is also what buffered ETFs you were describing before, I believe, mostly the philosophy or how those are built. And that is a really, really great tool for someone that owns a lot of one stock, like our clients that live in Silicon Valley might own. If they tell me the price that they're willing to get out of that trade, we look at all the taxes and we say, yeah, that's a really reasonable thing to do. I'm aligned on that. The best thing to do is consider going to sell call options at that strike price. That sounds anathema to people. Whoa, Rubin, Peter, you're like low-cost, diversified, evidence-based investors. It's like, yeah, but there's a financial tool that accomplishes exactly what we're trying to accomplish, and we can get a premium for it. Someone's going to pay us for the right to do it. So having worked in that industry in my 20s in Chicago, I have a love for derivatives in the sense that there's cool history behind it. If you've ever been to any of the bars around the Chicago Board of Trade, there's cool culture around Chicago and trading and derivatives. And it's kind of a lost art as things have gone, not art, but a lot of that history is being forgotten because things have been digitized. So much is done online now. You live wherever you want. You can trade wherever you want. So I have a soft spot in my heart for that kind of thing. But also these tools, we read all the headlines about how dangerous they can be, playing options that expire in 4 hours and people are loading into them, hoping for some crazy rags to riches in 4 hours. But in reality, they're a tool like that. If you get the scalpel out, for some people make a lot of sense. But it's hard to do if you don't have an advisor that sort of knows what they're doing, or if you don't know what they're doing, it's hard to accomplish that. But I just have this strong belief that it's kind of a bummer how much high torque investment vehicles are misused because then you have all these horror stories, when in reality, for a lot of our clients, they're actually very, very helpful to manage risk. If you have a stock and you sell a call option on it at a certain price, you should actually expect that that's a less risky portfolio than just holding a stock. That's the buffered ETF type story as well. And I don't think most people would realize that.
Well, Rubin, I'm going to definitely link to that article in the show notes at thelongterminvestor.com. And for our viewers, for our listeners, I'm also going to link to something that I wrote for the Journal of Financial Planning that goes deeper into some of these option strategies, especially if you're holding on to a concentrated stock position. Really something as we've been talking about the trade-offs of certainty and uncertainty, an important thing to cover. But I know we're out of time. Before we let you go, Rubin, if people want to find more of your work, where should they be looking?
Oh, sure. Thanks. My blog is Fortunes and Frictions, as you said. You can connect me on LinkedIn. I'm on Twitter. I tend to poke around at the advisor conferences as well. And you can reach out to me on my firm's website too, if you want to chat or anything like that.
Well, nobody writes more about the risk-free rate than Rubin on LinkedIn. and that's probably because money never sleeps to him. So again, I appreciate you being here, Rubin. And to all of us watching, listening, we will see you next time.
Thanks, Peter.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.